Hey guys, and welcome to the Ultimate Fibonacci Trading System explanation video. Before we get started, I just want to say a massive thank you for all the support we've been getting in our previous videos, as it really means a lot. The Ultimate Fibonacci Trading System consists of four main components: the Fibonacci retracement, Fibonacci extension, exponential moving average, as well as intraday market structure. Let's explore the logic behind these four components before looking at how we can combine them in our profitable trading system. Fibonacci retracements and extensions are based around a number sequence called the Fibonacci sequence that was discovered in the late 1100s by Leonardo Pisano, who was an Italian mathematician. Often newer traders will believe that the Fibonacci levels are like a kind of self-fulfilling prophecy. It should be known that these levels hold no more strength or validity than any level on the chart, and whilst we do see Fibonacci in a lot of nature, such as galaxies, seashells and flowers, I do have to quote Neil deGrasse Tyson, who says, "There are more instances in the universe where Fibonacci is not relevant than where it is." Our next tool is the 200 EMA. Unlike Fibonacci retracements and extensions, there is a lot more rationale behind using the 200 exponential moving average within this system. This tool provides us with directional bias when we are trading. As you should know from various videos in the 365 Days of Forex series, we always want to use the higher time frame bias to our advantage when we're trading. By using the 200 EMA on the hour time frame, we're able to quickly assess where price is currently in relation to the previous 200 hours of trading. This mechanical method of attaining directional bias not only makes backtesting the strategy significantly more efficient, but it also removes an element of discretion from what is a very discretionary based system. The third tool in our trading toolbox is intraday market structure. We can use levels of support and resistance in our entry time frame to add further confidence to our trading setups. This could be a level of support, resistance, or a psychological level in the market, such as a round number. By combining this with our Fibonacci retracements, we'll be able to locate much more precise entry points into the market. Now we have the components of the strategy, let's take a look at a strategy breakdown that will allow you to visualize the strategy a whole lot better. As you can see, we're on USD JPY, and we're going to establish our directional bias by using the 200 period EMA, which we've already added to our chart. If we compare current price action to our EMA, we can see that price is currently trading above the EMA, which signifies that price is in an uptrend. Now that we've established our directional bias, we need to look for our market structure before we begin plotting our Fibonacci retracement. Whilst we could mark levels of structure here and here, we want to remove clutter from our charts to prevent confusion when we're trading, and therefore we only want key levels on our chart. If we look at this level here, we can see it fits our criteria to be a good level, as it has the following properties. The level has multiple rejections, there are long wick rejections from the level, and most importantly, it's been tested as both support and resistance, making it an inverse level. If you also look at our level, we can see that it was recently broken by an impulsive move to the upside, and as price retraces, we can look to combine the rounded retest of this level with a Fibonacci level to layer our confluences even further. Now let's take a closer look at the recent price action. The first step that we need to take before we add our Fibonacci retracement tool to our chart is to identify the swing points that we'll be using for this trade. I've identified this candle as my swing low, and this candle as my swing high. Now let's mark our Fibonacci retracement tool onto our chart. As we can see on the chart, the 61.8% Fibonacci retracement level and the level of structure that we drew on the chart previously align almost perfectly, providing us with the confidence that this would be a good point to enter a long trend continuation trade. Now we have identified our entry point for this position, which will be after price has tested the 61.8% level, we can begin to look for a stop loss placement. We use a stop loss so that we can accurately quantify our risk when we are trading, and make sure that we're using the correct position size when we place our trades. With this position, we're going to use our level of market structure in conjunction with the 786 level to ensure that our stop loss won't be triggered during the retracement before the pullback. As a result of the 786 level being below the level of structure, we will place our stop loss at the lower 786 level to provide our position with more room to metaphorically breathe. With our stop loss located at the 786 level, we now need to look at our Fibonacci extensions to provide our target for this position. Some traders will aim to target the negative 61.8%, but with this system, I have found more success targeting the negative 27.2% level. This more conservative level is essentially a 27.2% extension on top of our original retracement that we're targeting. Let's now add the position tool to our chart so that we can review our risk to reward ratio that we would achieve with this position. We can see that the trade has a 5.13R ratio, What this means is that if we risked 1% in this position, if our trade goes to our target, we'll make 5.13 times what we've risked, or in this case, 5.13%. If we lost this trade, we would lose the 1%. Let's fast forward time and see how this position plays out. As we can see, price has gone on and hit our target with an impulsive move to the upside, bagging us 5.13% with this single position. While you're watching this, guys, I do have to say these videos take a lot of time for us to produce, and therefore if you could take a moment out of your day to subscribe to the channel and let us know in the comments what videos you'd like us to cover in the future, it would be really appreciated. Now moving on, an often overlooked topic when other educators cover trading strategies is the common problems that you'll likely face when you begin trading and testing this strategy. With that being said, here's 3 common problems that will damage your profitability when using this strategy. Problem 1, swing points. Make sure when you're identifying swing points in the market, you look for large impulsive swings that will be visible on the higher time frames as well as the time frame that you're trading on. Problem 2, stop losses. Or should I say, getting greedy. It's super easy when you're trading to get greedy and not give your trade enough room to breathe because you try to target that crazy risk reward trade. Remember, it's always better to win a 2.5 hour trade than lose a 5 hour trade. Problem 3, overthinking. When you're trading with discretion, you need to let your intuition guide you on trades. To prevent overthinking, always backtest your system before taking it into the live markets so you've got less to worry about. So now you know the components of the strategy, how to implement those components into your own trading, and the common problems that people experience. Why not try using an ATR based stop or a 50 EMA as dynamic support and resistance to add confidence to your setups and see if that improves your profitability. As always, if you have any questions about this strategy or you'd like me to cover anything that I've mentioned in this strategy breakdown in a little bit more detail, then let us know down below in the comments. If you enjoyed the video, then please like and subscribe. And with that being said, cheers guys, and I will see you in the next one.